All right. Hello, everybody. Welcome to the Whitaker-Myers Wealth Managers monthly webinar series. If you're here today, it means you're one of the few, the proud, the people who find tax planning genuinely exciting. And honestly, we love you for that. And there's a lot to be excited about this time of year. We've got tax bracket updates, new standard deduction numbers, changes to the SALT cap, and plenty more. Of course, we can't ignore the star of the show, the one big, beautiful bill, which brought along some major updates, including the new senior bonus deduction. We're going to get into all of it today. Our resident expert, Kage Rush, CPA, will walk you through what these changes mean and how to plan around them. But first, Kage, I have a question for you. Why did the accountant cross the road? To reconcile the other side. I know, thank you. Okay, one more. Why do accountants make great comedians? Their jokes always add up. All right, if you want to put an end to this misery, I need you to do something for me. I'm going to put a link in the Q&A section right now. So navigate to your Q&A section of your webinar portal. Click on that link. That is a link to our YouTube page. And let me share my screen here real quick. Navigate to our YouTube page, and there should be a button right in the middle called subscribe. So please click on your YouTube page, click subscribe. This will ensure you get our latest updates. And on this page, there's all of our previous webinars. I do a weekly video called Your Financial Journey. Sumit Puri, our co-chief investment officer, does what we learned in the markets, puts out a ton of great information. Well, without further ado, Kage, I'm going to let you take it away and make sure you're unmuted there. I don't know if you...
I think I'm good now. I hit my...
Thanks.
Yep, perfect. Well, I hope everyone is getting ready for a wonderful Thanksgiving. I can think of nothing better while you're falling the turkey and getting ready for Thursday than listening to tax planning, because those go so hand in hand together. So I'm going to start sharing my screen here for the presentation. And as Tim said, this was a very big year for, the folks of my world, as we finally got some answers onto what was going to happen with the Tax Cut and Jobs Act. No better than Independence Day to get that all resolved. But we're going to go into it, talk about the new tax brackets for this year, 2025, so coming up on the end of the year, as well as some of the new laws that are effective this year and some excellent planning opportunities they do present for you. No matter what age range you are in, of your life, whether you're in retirement and you're looking at Roth conversions, or you're in the middle of your life and you're making high income and want to be able to make a difference through your community, through giving, there's unique ways the tax laws give you to do that in an efficient way. So to get things started, I just want to go through a legal disclaimer real quick. The IRS is always issuing new guidance, so all this is subject to change, just as far as they may issue guidance on reporting standards, as far as the overtime deduction and tips deduction that has not been formally finalized yet. So everything we're talking about today is the tax law as it is today. So to talk about the 2025 tax year in review, I cannot believe we're almost at the end of November. It feels like yesterday we were planning our webinar back in July once the bill had finally passed. So time flies when you're having fun. But as we look through the tax brackets and see, the biggest thing that One Big Beautiful Bill did was it kept the tax brackets from the Tax Cut and Jobs Act in place. What people don't realize is all these brackets were set to go back to the old rates where the max was 39.6% prior to 2017. So one of the best things this bill did was keep the lower tax brackets in place. And what that does is when you're in retirement and you're looking at Roth conversions, you have more room to do conversions at a lower tax rate. And if you're hardworking, working towards retirement, less of that dollar is being taxed in lower brackets while you're actively working. As far as the capital gain tax brackets go, that is the bottom part of your webinar. And as you can see, if you're married filing jointly, you can have a 0% tax bill if you recognize capital gains and your taxable income is below $96,700. So if you're someone that's living very frugally in retirement, you might be able to get some tax-free income if you're recognizing capital gains from a brokerage account or the sale of some property, but we keep you below that $96,700 of taxable income. And when we talk about taxable income, we're talking about your adjusted gross income, less the standard deduction, and less the additional senior deduction that we're going to talk about here shortly. So when you think 96,000, like, that's not a lot of income, that's your taxable income. So the standard deduction this year is 31,500. So you could have adjusted gross income of 127,000 and still pay 0% capital gains taxes because of the standard deduction. So that's an important note I like to differentiate, because a lot of the tax laws and limitations are based on your adjusted gross income, not your taxable income like capital gains are. And as we talk about the standard deduction, they kept the higher standard deduction limits from the Tax Cut and Jobs Act, and they will get adjusted up for inflation each year. One thing that has been kind of confusing post One Big Beautiful Bill was the additional senior deduction versus the additional deduction that was already in the tax laws for being 65 or older. So to provide some clarity on that, is if you're someone that just turned 65 this year, you don't have to be 65 for the whole year. You just have to be 65 by December 31st. So if you're one of those lucky folks who has a New Year's Eve birthday and you're going to turn 65 this year, well, you're going to have some extra deductions coming your way just for being 65 by the end of the calendar year. But this additional deduction of $1,600 if you're married filing jointly is applicable per person that is above 65. So if both spouses are above 65, it's an extra $3,200 to your standard deduction. If just one of you above the age of 65, it's only $1,600. So as we go into the end of the year, some relevant tax law limitations that you guys want to be aware of, just to make sure as we come into tax season that you're kind of keeping an eye on these things in case there's some adjustments you need to make with your financial advisor, not only this year but kind of going into next year. The big one we always run into a lot during tax season is the Roth IRA contribution limits. So if you're someone who got a huge bump in work, received a high bonus, you might want to make sure that your adjusted gross income is still below $236,000 if you want to take advantage of the standard Roth contribution limits. If you're someone that's already been above that limit, chances are you're already doing backdoor Roth conversions, or if you're not, you need to find a financial advisor that's helping you do those. And the $236,000 isn't as big of a limit deal for you. But if it is, there are some ways to reduce that AGI number before the end of the year. That could be something as simple as switching your contribution from post-tax sellers Roth 401k to traditional 401k, or contributing to an HSA if you're on a high deductible plan. 401k contributions are $23,500 if you're below the age of 50. There is a $7,500 catch-up if you're 50 or older, and then if you're between the ages of 60 to 63, your catch-up is actually $11,250. So they gave you an extra bump step up from the new Secure Act 2.0 rules. And one important note to note about the catch-up rule is starting in 2026, if you're someone that makes over $150,000 of adjusted gross income, your catch-up contribution is required to be post-tax dollars. So they won't give you the additional $7,500 off your tax bill if you make more than $150,000 and then you're in a standard 401k plan. So that's something to note as you kind of go into next year when you're looking through that. For Social Security taxes and self-employment earnings, the max they can tax you on Social Security, which is 12.4%, is up to $176,000 of income, or roughly about $10,918 of taxes. Why that's important is if you're someone that's working full-time and you have a side, a thing you do on the side or an extra income, is Social Security tax won't tax your combined net income from your small business or side job plus your W-2 job. They won't double tax your Social Security if your wages exceed the $176,000. So that is an important piece to know if you have that situation going on. The child tax credit also got a nice little bump, and then it will start to get adjusted for inflation moving forward after 2026. That credit is $2,200 for qualified dependents under the age of 17. If they turn 17 during the year, that credit goes from $2,200 down to $500. So as you're looking at your W-2 pay stubs at the end of this year and kind of going into next year, it's always good to review your dependents. And if you have a child that's turning 17, to make sure you get your withholdings at work updated on your W-4 to reflect that, because if not, you're going to have a surprise bill of $1,700 of under withholding when that switch happens. So at the end of the year, when you're looking at your pay stub and W-4, you want to make sure your dependents' ages line up with the tax credits that you're allowed. And the $400,000 limit that was in place for your adjusted gross income is still in place. So if you make above $400,000 of adjusted gross income, they start to limit the amount of your child tax credit, and it goes down by $50 per child for every thousand you cross over the $400,000 threshold. So again, if you're someone that's starting to make more money and you're looking at these applicable limits, it starts to make more sense to possibly think about switching your Roth 401k contributions to pre-tax, not only because of the tax savings you get today, but also being able to keep the child tax credit, because that is a sizable tax credit and it is per dependent. So obviously the more qualifying children you have to qualify for this credit, the more relevant it is that you try to stay below $400,000 of AGI in every legal way possible. If you do have no income tax liability, the tax credit is reduced to $1,700 refundable, and you have to have at least $2,500 in earnings to qualify. This was a new wrinkle that was added in from the One Big Beautiful Bill, just to make people aware. So if you're not working and you have this issue, you may not qualify for part of the child tax credit unless you have at least $2,500 in earnings.
All right, Kage, I just wanted to jump in here. Can you go back to the standard deductions real quick? And just wanted to highlight this new senior bonus deduction, Kage. It's only available for the next 4 years starting this year, correct?
Correct.
So you have, seniors among us have from 2025, 26, 27, and 28, and then this sunsets and this bonus deduction goes away. So we've been talking about some opportunities for the more mature among us. It's almost like an infomercial. I mean, you have the huge standard deduction. You get this extra $1,600 per person if you're married, filing joint in the deduction, and then you get the senior bonus deduction on top of that. So this can drastically reduce your adjusted gross income. And you were talking about, Kage, this might make your capital gains rate, that 0% capital gains rate, that's based on your taxable income after all of those deductions. So seniors need to think about, is there a potential to harvest some gains in your taxable accounts at a 0%? A lot of financial advisors talk about tax loss harvesting, but you should be thinking about tax gain harvesting, just reducing your cost basis in case you need to sell something in the future. You can reduce that. The other thing we've been talking about is, could this give an opportunity for somebody 65 and over to do a Roth conversion? So, Kage, what are some of the things you think about when it comes to doing a Roth conversion? We're not talking about after the deduction, so that is bumping up your adjusted gross income. What are some things you have to be careful about when you're doing Roth conversions about increasing your adjusted gross income when it comes to taxes?
So yeah, there's definitely a couple of things you want to look out for with Roth conversions, and we definitely recommend talking with your financial advisor and your tax preparer when you're looking to do these Roth conversions, because when you're retired, they do affect a number of things in your life. So the first one is obviously your income tax. That's the biggest one. If you do a Roth conversion, you're going to pay taxes on it. So what you want to make sure you're doing is maximizing the tax bracket that you're in. You don't want to go too high into a tax bracket when you're doing a Roth conversion. But when you do the Roth conversion, that's going to increase your AGI. And one thing about the additional senior deduction is that it does begin to phase out if you're single and you make more than $75,000 of adjusted gross income. And if you're married filing jointly, it starts to phase out if you make over $150,000. So there are these somewhat soft ceilings that you have to look out for when you're doing a Roth conversion, because then you slowly start to lose those additional senior deductions. The other thing you want to look out for, of course, is IRMA. Your Medicare premiums are affected by your adjusted gross income. So if you're someone that, you have a good pension, you have Social Security income, you have some interest and dividends from a brokerage, is that when you do a Roth conversion, you're bumping up your taxable income and just making sure you're aware of the implications if you do a Roth conversion, that if it does adjust your Medicare premium, just being prepared for that. And some folks are perfectly fine with that, and other folks don't want that. So that's the stuff that your financial advisor should be helping you look through when you're looking at these. And if you're someone that's in that you haven't hit Medicare yet and you're retired, so that 59.5 to 65 window is, chances are, if you're not on COBRA insurance, which is offered by your employer, if you decide to retire for 18 months, if they offer it, you're most likely going to the marketplace. And with the marketplace plan, that is another thing that is based off your adjusted gross income. So if you're looking to do Roth conversions while you have the 10-year window or 12, 13-year window before you hit RMD age, you need to be aware that Roth conversions are going to impact your marketplace premium as well. So a lot of things do come into play when you look at Roth conversions, and it's always a nuanced conversation of making sure we're keeping you in the applicable limits to not cause you unnecessary burdens from a tax perspective, but also just from a practicality perspective. And sometimes if your pre-tax dollars in your 401k are so high, you kind of have to bite the bullet the first couple of years, but being aware that those are coming is much better, and planning for those than doing it and then going to your tax preparer during tax season and seeing that surprise tax bill.
Yeah. Yeah. And the amount of your Social Security benefit, if you are collecting Social Security, the amount of that which is taxable is based on your adjusted gross income. So there's all types of if-then type of formulas. You need to be careful and talk to somebody who knows what they're doing, is considering all of those. Even with all of that, many times, depending on your particular case, there are advantages to doing Roth conversions. A lot of that is down the road to help reduce your required minimum distributions or even legacy planning. We've been running some analysis, parents essentially doing some Roth conversions, understanding the impact of all of those things that we talked about, but being able to pass on assets tax-free versus their kids inherit a taxable traditional IRA. We have a question here. I just want to point to it real quick, and thank you for your questions. You can submit questions on your Q&A form there on the webinar. You're welcome to do that anonymously. There is a box you can check to ask that anonymously. The question is, if you have a Roth on your own, can you put $8,000 into that in addition to, I'm assuming, your plan at work? And yes, those contribution limits are independent of each other. If you have a 401k, you can max that out. And in addition to that, you can max out a traditional or a Roth IRA. Those are independent. So make sure you're considering all of those when saving. All of those limits did go up for 2026. You're probably covering that here, Kage. I did a video on that. You can reference that on our YouTube channel. Very exciting updates. Go ahead, Kage. I'll hand it back to you.
No, you're good. It's an excellent conversation. And with the One Big Beautiful Bill, I'm gonna dive a little deeper into the senior deduction, but I want to talk about the individual side of things and the changes that the One Big Beautiful Bill have that's going to present from the individual side of the tax code and couples and families. What are the things that the One Big Beautiful did that will help you, and you can start to plan around that? If you're above the age of 65, we kind of talked about the last couple of minutes here, is the additional senior deduction of $6,000 per individual that is 65 or older as of December 31st, 2025, and that's 4 years this year, 26, 27, 28. And notice how I said per individual. So if you are married filing jointly and both spouses are above the age of 65, that additional senior deduction is actually $12,000, not $6,000. So again, it gives you more room in a lower tax bracket to have considerations about possible 0% capital gains tax, Roth conversions, and just saving money in your cash flow. So that's definitely things you want to consider when we're looking at it. Another big change, this one is for more high income earners, but it might also impact just people that, if you live in Ohio, there is no shortage of state and local taxes that you have to pay depending on where you live and where you work. So you might have a deduction that was previously limited. Now, because of this law change, you are much closer to itemizing than you may realize. And what that change was, the state and local tax deduction, or SALT, was capped at $10,000 from 2017 to 2024. And what SALT looks at is the amount of taxes you pay to your state for your property residence, your local taxes paid if you have to pay vehicle taxes. For Ohio, we have school district taxes, city taxes, municipal taxes, all over the place. They look at the combination of those numbers and said, no matter how much you make, you can only deduct $10,000 towards itemizing. So as you can see, if you're in a high income tax rate like California, New York, and other states, and sometimes even with Ohio can sneak up on you depending where you live, that deduction was always capped at $10,000 for you. Well, for 25 through 28, they've actually raised that limit up to $40,000, which is a $30,000 jump from what it was previously, as long as you make below $500,000 of adjusted gross income. What starts to happen once you make above $500,000 is they begin to reduce that benefit of $40,000 back down to the $10,000 limitation. So if you're a high income earner and you're right above that threshold of $500,000 or getting close, we should be doing everything in your power to get you below that $500,000 limit, because you start to lose the benefit of the SALT tax deduction at 35 cents on the dollar until you get back down to 10%. So that's definitely something you want to be mindful of, and we'll talk through that a little bit more coming up. But they also added a new overtime deduction that is up to $12,500 of qualified overtime compensation, $25,000 if you're married, filing jointly. The new tips deduction, which is up to $25,000 on qualified tips. And then I kind of touched on it at the beginning, but just making the current income tax brackets permanent was so huge, because people don't realize that the 24% brackets and 22% brackets started at much lower levels than what they are now under the old bracket. So just keeping these brackets permanent until another administration come in, and they may change it, they may not. But just knowing clarity what we have for the next 4 years is huge on that. And now I'm going to kind of walk through each one of these a little bit individually and go into a little bit more detail. So I'm going to start with the additional senior deduction. And as I mentioned, it's $6,000 per individual that qualifies for the next 4 years. So the one thing you have to watch out for with this deduction is just the income limits of where it starts to phase out at $75,000 if you're single or head of household, and $150,000 if you're married, filing jointly. When you start to get above those limits, they start to phase out a little by little. It's not a sudden dip off, but it does drop a little bit. But the nice and great planning opportunity with this additional senior deduction is with the new higher standard deduction of $31,500, as we talked about, $15,750 if you're single. There's a scenario where if you're a retired couple above the age of 65, as of the end of the year, you could have a senior deduction of $46,700, which is, up obviously $12,000 from what it was previously. But when you start to go back and look at it, you could have up to $146,000 of income and just start to pay capital gains tax, in this new bracket for the next 4 years. So as Tim mentioned previously, if you have a brokerage account where you have some gains that you're worried about selling because of the tax implications, if we know you're in this range to do that 0%, it makes it easier for your advisor to rebalance his account so you can, again, reset your cost basis in that account, buy it at the higher rate, and then if you need that cash more liquid, you obviously have that option to you without the burden of the potential tax burden. With that $46,700, it also gives you more room to do Roth conversions in the 12% bracket, and stay in that 12% bracket. And if you're someone that was already, below, 60 or 96,000 of taxable income, and you're saying, well, I'm already getting, 0% capital gains tax. Well, now you get even more room to recognize more capital gains. So you can even increase your standard of living a little bit. So it gives you a good 4-year window to maybe get a little more aggressive in some Roth conversions as far as the amounts you're wanting to do because of these additional deductions. And the big thing is that this isn't guaranteed to stay post 2028. So that's why we tell clients, we have to work with the laws that are in play now, because we don't know what the future holds. And obviously with 2028 being an election year, all these laws are going to come up again in 4 years when it comes time to vote on the next president. So taking advantage of the laws as they are today and as we know they're going to be for the next 4 years can make such a difference in your financial planning and legacy planning perspective that if the laws do change and they're less favorable, well, we were able to do some significant financial gains now in the next 4 years while we have these more favorable tax brackets.
Yeah, and Kage, we've been talking with our clients about a couple other ways to handle gains in your taxable portfolio. One of those is to donate appreciated securities. So if you do have something in your account that has gone up, thank the Lord, use that for your charitable giving. Kage, what are the limits on that as far as deducting something that you gave away in that form?
Yeah. So with charitable giving, that is going to come down to your, when you're looking to itemize your deductions. So there's two different, sets of charitable donations. There's cash donations, and then there's non-cash donations. Cash donations, straightforward, that is limited to 60% of your adjusted gross income in the given year. So if you're someone that has $150,000 of adjusted gross income, you could give up to $90,000 in cash and, deduct that off your tax return in that given year. With non-cash items like property, your goodwill donations, and appreciated stock, that is limited to 30% of your adjusted gross income. So in the same scenario, if someone that makes $150,000, your appreciated stock donation would be limited to $45,000. When you do a combination of both cash and non-cash items, your overall limit is 50%. So if you're someone that makes $150,000 and you want to do both, you both want to give cash and you want to give appreciated stock, your combined contribution of those has to be 50%. So we would tell clients in that scenario, you would do 30% appreciated stock, 20% cash to get you to that 50% threshold. So appreciated stock and donating appreciated stock is a win-win for everyone involved if you're, wanting to do it for the right reasons and it makes sense from a financial planning perspective. The worst thing that you can worry about is, being a buy and hold investor and you've done the right thing, you've bought the right stock, you've held it, and now you have the issue of, I have so much money in one stock, if this stock tanks, my retirement tanks. How do I reset my cost basis without giving 25% to my federal and state authorities? And that's where appreciated stock can come in and help you a little bit, kind of ease that burden. And most 501(c) charities allow you to donate appreciated stock. And if they don't, or if your local church doesn't, our financial advisors at the Wealth Management Firm have helped their clients, help their churches set up these type of accounts to allow these type of donations, because it's the win-win from the client side of you is they can start to bring down that capital gain issue that they're going to have long term. The charity is going to get the fair market value of the stock when they get it, and because they're a nonprofit, they can sell the stock next day with no tax implications, and they don't have to pay taxes on the gain. So they're getting the true value of the stock. Whereas if you sell the stock and then give it to the charity, you're giving 25% of that to the government, possibly between capital gains taxes, possibly net investment income tax, and then your state tax, depending on where you live. So appreciated stock can be a powerful tool if it's for the right reasons and you want to reset your cost basis, and you want to be extremely charitable. So we highly recommend it's worth a review if you have that kind of situation and you're worried about I like this stock, but I can't sell it now. I'm kind of handcuffed because I make too much money. I'm not in the 0% capital gains bracket, and I don't need the money, but this issue is only going to continue to get larger if we don't start to address it.
Yeah, and of course, we've utilized the increasingly popular donor-advised fund. You can gift away those appreciated securities, get the tax deduction for that. It's outside of your estate, essentially. You get the tax deduction, but you still have control to make grants from that donor-advised fund. The donor-advised fund can stay invested according to your direction. Very, very popular tool these days. Another tax-friendly way of handling that gains, Kage, is just to pass away, right? It's actually a tax-efficient way to pass along assets because all of those gains, essentially, disappear, you get a step up in cost basis of all of those holdings if it's owned just in your name, if it's owned by joint, and we're dealing with some of those scenarios too.
Yeah, and so when you look at, legacy planning and estate planning, brokerage accounts and, Roth IRAs are the most tax advantage assets to give to your heirs or give to, when you're looking at charities, if you want to give some of your, estate away to charity, we would tell you to give it to your IRA because, again, it's a nonprofit. It doesn't have any tax implications to where if your kids get a traditional IRA inherited to them, under the new Secure Act rules, if they meet qualifications, they're going to have to liquidate it within 10 years, and they're going to pay taxes on all those withdrawals. If your children inherit a Roth IRA, they can keep it sitting for 10 years, but they just have to take it all out by the end of 10 years. And if it's a brokerage account they inherit, they get a step up in basis to whatever the stock was worth on the date of passing. So definitely some unique planning opportunities depending on your situation with the current tax law changes, just to sit down. And it's always worth at least once a year to look at your estate and just make sure everything lines up with what you're wanting to accomplish. Life changes, plans change. So your financial plan should change with them. So, we always stress to clients that be mindful of as you're going through your life, as changes happen, make your financial advisor aware of those changes so that they can, update your financial plan, get your appropriate beneficiaries uploaded. So if something does happen, everyone's on the same page with what's going on. So the next change was the increase the SALT tax deduction from $10,000 to $40,000. And I kind of touched on it a little bit, but if you're someone that is already paying high state and local taxes, you were previously capped at $10,000. So by simply just this law changing, your itemized deductions may increase because of the increase in the SALT tax deduction. And that, again, looks at your primary residence property taxes paid. If you have a vacation home, its property taxes paid. Your mortgage interest, as long as it's below $750,000 of indebtedness at the end of the year, and your donations to charity. So when you look at the combination of those three things and medical expenses, if you unfortunate have a high medical expense year, all those things go into your itemized deduction. So if you're a high income earner before the end of the year, I would recommend taking a look back at your 2024 taxes and see if you did itemize. Because if you did, it will tell you the amount of state and local taxes that you paid on your Schedule A, and you may unlock deductions that weren't there previously just by simply this law changing. So that's a nice little savings if you can stay below that $500,000 of AGI. And we'll talk about at the end with one of the webinar examples, but with this increase in SALT tax deduction, it can put you a lot closer to itemizing. And if you're someone that already has a donor advised fund established, it may make sense to lump your charitable donations into one tax year, because there are some changes coming to charitable donations in 2026 that'll slightly decrease the amount that you can, deduct if you're an itemizer. So it's something that you want to be looking out, if it makes sense to do a lump sum donation before the end of the year. The new overtime and tips deduction. So the overtime deduction is $12,500 per qualified person, up to $25,000 married filing jointly. The range out phase is if you're $150,000 or higher if you're single, $300,000 if married filing jointly. The one thing about married filing jointly that's important to note is that only one spouse needs to have overtime to qualify for the full $25,000 deduction. So both spouses don't have to be working overtime if one is making that $25,000 limit to get that full deduction. For the tips deduction, that's just a straight $25,000 deduction on qualified tips, and it has the same phase-out ranges as the overtime deduction. The nice planning perspective when you're looking at your financial plan is that, these new deductions kind of allow you ways to accelerate your earnings. So if you're someone that's working to get out of debt and you want to fast track to get out of debt a little bit faster, these new tools allow you to do that in this 4-year window without feeling burdened by the tax that you pay when you work overtime. If you've ever talked to anyone that works overtime, after so many hours, it's like you're paying them to work at some point because so much money is being taken out in taxes on the overtime rules. So one little tip here for tax preparation for next year, the IRS still has not finalized the reporting requirements around tips and qualified overtime for employers. So what I would recommend is, if you are someone that has qualified tips or is working overtime, is provide your tax preparer with a copy of your 1231 pay stub that shows your year-to-date overtime deducted, so that you can make sure you get that deduction claimed for your 2025 tax return. They're not penalizing employers for not reporting it properly in 25. So I kind of take that as a lot of folks may not get it reported to them properly in 2025. So to be ready for it, just have a copy of your 1231 pay stub that shows your year-to-date payroll information, that shows year-to-date overtime or year-to-date qualified tips to take advantage of those deductions. And I kind of touched on this already. It's just the current tax bracket paying is huge. We're able to, pay less taxes and, keep a little bit more of your money, and that helps obviously with the rising cost of everything and, just wanting to do Roth conversions and retirement planning. And then now that we've touched on the individual side, I want to talk about the business side of the One Big Beautiful Bill and what were the changes there, or what stayed that, that help small business owners and people that run businesses. And the two biggest things, for most businesses, there are nuanced things that each, depending on what sector of business you're in, you might have had something from the One Big Beautiful Bill that qualifies. So we're taking an overall arching approach to what helps businesses here. The biggest one is retaining the qualified business income deduction of 20% on your qualifying Schedule C, partnership, S corporation pass-through income. What this deduction allows you to do is, if your S corporation income as an owner was $100,000, if you're within the applicable income brackets, the IRS allows you to take 20% of that off your taxable income. So that's a $20,000 deduction for not having to do anything. So that's massive, and that was, again, getting ready to be pulled back out of the Tax Cut and Jobs Act. So people were going to see a huge hike in their tax bill just for it not being extended. So by the fact that they made it permanent is a really good sign, and I think it's going to continue to stay. But that's one big thing that we don't have to worry about going away for the next 4 years. And then the other thing that they did is they brought back 100% bonus depreciation for the years 2025 through 2028. They had, in the last couple of years, started stair-stepping down that deduction by 20%. So if you bought qualifying assets in 2022, you got to deduct 100%. Then in 2023, it was 80, in 24 it was 60, and 25 was going to be 40. So they brought it back to 100% through 2028. So if you're looking to expand your business, looking to take advantage of some deductions, the bonus depreciation is a good one to buy the assets you need today to get the job done and get the tax deduction all at the same time. And then there were two things that they did that will help just reporting requirements for small businesses. Anyone that's ever issued 1099s to people for 1099 NECs know how much of a hassle that is to track, because the reporting requirement used to be $600 and then you had to send out a 1099. They've actually raised that limit to $2,000 per contractor. So again, if they're below that limit, you're not required to send them a 1099. It doesn't mean the person is not required to not claim the income. It just means you as the employer is not required to send a 1099 NEC or miscellaneous form to them. And then for the 1099K reporting, this has to deal with your Venmo transactions, your electronic transactions. There was a lot of ordeal about this back in 2021. They lowered the limits to the same limits as the 1099 NEC contracting reporting requirements of $600 or so many transactions. Everyone hated it. They put it on hold, and then they put it back to the old limits. So those are back to the $20,000 or more of transactions, or over 300 in total. So if you're someone that was, collecting rent from your tenants via Venmo, you don't have to worry about getting a 1099K and being confused again as to why am I getting this form. Or if you sold a couch on Venmo for $1,000, you're not again worried about getting a 1099K and having to tell the IRS you sold it for a loss and it's not truly a gain. So those were some small administrative burdens that they helped alleviate on people there. And then as far as, I like to go through this every year. It feels like every year we always have tax issues that arise during tax season. And some of them are common, some of them are not so common. So I always like to take the ones that I see the most during tax season and just bring them up this time of year so that if you're going to think you're going to fall into one of those brackets, there are ways to help you alleviate that, or just know that there are steps to take to get you in compliance, and not worry about the IRS coming down your neck for stuff. Some of those can be just either over contributing to your 401k or IRAs because you either made too much money, or you switched jobs and you accidentally over contributed to your 401k. If you're on a marketplace plan, if you have something that causes your income to rise, we talk about what's the best way to handle that during the year and not have it be such a big deal when you go to file your taxes. If you're opening up new investment accounts, just understanding what are the reporting requirements with those accounts, and be communicating with your tax preparer as you open those new accounts, so that your tax preparer, and the tax preparer is going to know what forms to give you. But if you don't know to tell your tax preparer that you open these new accounts, they may not ask for those accounts, for those forms. And then if you're someone that is constantly over or under withholding, just taking a look at your withholdings, it might be worth to have a quick discussion with your tax preparer to ask how to, what's the best way to get those corrected, or that you're in the right place and, things are good to go there. So a lot of these problems can be resolved just by simply being proactive and, talking to your financial advisor when there's a life-changing situation that may impact one of those things we talked about previously. And most financial advisors are really knowledgeable and tell you how to resolve these issues. But again, the big thing is just being proactive. It's the hardest time to solve a tax problem is during tax season, because a lot of the times, there's not a whole lot we can do for you, whether it's trying to reduce your income. There are avenues you can take, but they're not available to all taxpayers. It kind of depends on your individual situation. So if you're someone that got a huge raise at work or got a huge bonus and now you're over the Roth IRA limit, let your financial advisor know in January when you see that, because we can get the necessary paperwork filed to unwind those contributions for you in a timely manner, get it all reported properly before you file your taxes in 2026. And it's no sweat to do it. But again, it's just financial advisor knowing to communicate with the taxpayer what needs to happen there to make sure it's all done smooth for you. So the longer you have that issue and the longer you wait into tax season, the less time you have to get it unwound. And, you're working with the custodian, then you're working with your advisor, then you're also communicating with your tax preparer. So if all of your stuff is not in one house, as far as working with the custodian to get that all resolved, that could be a lot of back and forth and be very stressful for you if you're not proactive with your situation, or just even at your annual review, just, letting your financial advisor know if there's been a jump in your income so they can, make you aware of those limits and let you know that you're coming close up on the Roth IRA contribution limits. Or if you do this is going to raise your health marketplace plan. We might want to let your, insurance agent know what your new adjusted gross income is, so we can adjust your subsidy so that you're not having to pay all that subsidy back when you file the following tax year. And when you open up new investment accounts, it's always just best to understand the implications of those investment accounts and what is the reporting around those investment accounts. If you open up a brokerage account, it's not like an IRA where your earnings are deferred. You're going to pay tax on the dividends when they're earned. You're going to pay tax on the interest when they're earned. You're going to pay tax on the capital gains when they're sold or swapped. So just knowing that it's not the same as an IRA, and that there is going to be a separate tax form to report that, and making sure you let your tax preparer know that, because the 1099 forms do take longer to issue than other W-2s, 1099, NECs, other forms like that, because their reporting deadline is not January 31st. It's actually towards the end of February. So it could be a delay in your filing that you're not used to, and that can lead to some frustration if you're just not aware of that. So always ask your financial advisor when opening up a new account, is there any tax implications, tax reporting requirements that I need to be aware of, so I can let my accountant know that I opened this, just so that everyone in your financial plan is on the same page with what's going on, making sure it's all good and done properly for you. And from a withholding perspective, it's always worth it at least once a year to have your withholdings looked at. If you're someone that's always been, I have folks that like getting huge refunds, and I like folks that if they could pay the IRS $0 and pay it all on April 15th, they would do it. There's disadvantages to both. Obviously, you don't want to loan the government too much money throughout the year when you can be using that to help with your monthly cash flow and fund your investment accounts throughout the year, as opposed to a lump sum April 15th. And then on the other end of the spectrum, if you don't pay the applicable amount of taxes, you could be subject to underpayment penalties and interest on those underpayment penalties. So there's a happy medium, and just making sure you're in line with your financial advisor and your tax preparer to make sure you kind of, stay in that medium threshold. It's all right there are ways to avoid underpayment penalties, and it's just understanding what those are. You can either pay 100% of your prior year tax bill or 90% of your current year projected bill. So if you're someone that owed $20,000 in 2024 and you're set to owe $25,000 in 2025, the two ways to avoid underpayment penalties is to have your estimated payments, W-2 withholdings, 1099 withholdings total $20,000, or you need to withhold $22,500 of combined of those sources. So just understanding that it's all right to owe a little bit to the government. It's not a huge deal when you file. It's just you don't want to be owing thousands and thousands every year and accrue those late payment penalties always if they can be avoided. Sometimes you're a small business owner and you don't know what your net profit's going to be until you get your tax return in March for the previous year because of people making adjustments to your books. So that's where tax planning can really help you. If you're a small business, sitting down with your CPA before the end of the year and just walking through your books and making sure you guys are on the same page as far as what your projected income is going to be, so that if you want to, buy some assets to get that bonus depreciation, or you want to fund a solo 401k or fund your company 401k to lower that tax burden, that's all done before the end of the year. And, tax filing season is just filing your taxes. It's not stressful. It's not, sweating, waiting to see what I'm going to owe. It's all been kind of discussed, talked about, and once you get your taxes, you continue running your business and onward and upward. As far as 2025 deadlines, there's no huge changes. I just always like to run through them in case people have some changes or open up a new business and they fall under one of these forms. If your 1040, your state tax returns or trust tax returns, and your corporate 1120 returns are still due April 15th. If you're someone that owns a partnership or an LLC that has more than one member, that is due March 15th. And if you're an S corporation, that is also due March 15th. The estimated payments are still due on the 15th in April, June, September, and the following January. And then your IRA contributions for 2025 are due April 15th, 2026. And if you have any recharacterizations of contributions because of the income limits that we talked about, those are due by April 15, 2026, unless the tax return is extended prior to the deadline. Another useful tool is if you're someone that has a SEP IRA or a solo 401k and you want to do employer contributions, you can extend your tax return and give you an additional 6 months to fund your prior year contributions for your SEP IRA or your employer contributions for your 401k. So that's something that can help you get the tax deduction for 24, but you're funding it, the end of the year, and then you just have to have it fully funded before you file by the extended deadline, which would usually be, depending on if you're an S Corp and you have a 401k plan, that extended deadline is September 15th. If you're a corporation or an individual Schedule C sole proprietorship, that extended deadline is October 15th. So that's all of 2025. Now we're going to touch into 2026 real quick. Going to go through the tax brackets and then talk through some of the planning opportunities as we kind of go into the next year. We did touch on most of the tax planning items as far as donor advised funds, Roth conversions, RMDs and stuff, but we're going to talk a little bit and deeper about those particular items. So we have about 10 to 15 minutes left. And then if anyone has any questions in the Q&A from the webinar, we'll be happy to answer them if we can live, or we'll get your questions after and send you an email, a follow-up email after. So 2 things I wanted to note with the tax brackets is for 2022, or for 2026, the 22% bracket starts at 6 figures, which is new. So you can make less than $100,800 and still be in the 12% bracket of taxable income, which is nice. So it's about a couple $1,000 bump from 2025. And then for capital gains, if you make less than $98,900 in 2026 of taxable income, 0% tax rate. As far as the standard deductions go, a little bit of a bump. These are going to get adjusted up for inflation each year. So as you're, going into the next year and you're thinking about whether I should, do a lump sum of donor advised contributions, or should I, pay ahead my property taxes if I'm able to, just remember that the standard deduction is going to go up each year. So you're having to cross a higher threshold. So if you're able to do lump sum contributions in 25, while the standard deduction is lower, you're going to get a better tax savings than you were if you wait till 26 or if you wait till 27 because of those bumps in inflation for those brackets. As we go to 2026, some things you should always look out for. If you're retired, always be reviewing your RMD requirements on your accounts. If you're someone that's been taking RMDs, you're fully aware. But if you're someone that's turning 73 and is subject to the RMD requirement, really talk with your financial advisor and understand what those requirements are and when they need to be out by. Definitely need to be reviewing your Roth conversion opportunities. Given the extended senior deduction, review the diversity of your tax investments. And this is something that has come up a lot, especially with retired folks. And as you start to get older and you shift from growing, focus on major growing your assets to now principal protecting your assets and income generating assets in retirement. I want to touch on that a little bit, and then also just review how you're giving to charity. Depending on your age, you might be able to, there are some tax advantage ways to give it. And we talked about the donor advised fund as well as just being able to lump sum for a tax deduction, but then through that donor advised fund, you can still do your monthly tithings to your church or your monthly donations to your qualified charity. There are two new things with the charitable giving for 2026. The first one is for itemized individuals. So if this is someone that's able to itemize their deductions because of state and local taxes, mortgage interest, or charity, there is a new 0.5% AGI floor that you have to meet when itemizing your deductions. I would like to meet the intern in Washington, D.C. that wrote that into the tax bill because I don't understand why they added it. But essentially what that means is if you're someone that makes $200,000 in income, you would have to give at least $1,000 to charity before they consider it for itemizing your deduction. So again, don't understand the concept behind it, but just something they wrote into the bill. For non-itemizers, they are bringing back the COVID deduction, where it was $150 single or $300 married filing jointly for cash donations if you weren't able to itemize. Those donations are now $1,000 if you're single, or $2,000 if married filing jointly. So even if you don't itemize, it's still worth it to give your charitable donations to your tax preparer because you still will be able to take advantage of the donation in one way, shape, or form. So, since 2023, the RMD age is 73 if you were born after 1950. If you turned 73 in 2026, your 2026 RMD is required to be taken by April 1st of the following year, or April 1st, 2027. You can elect to not take the initial RMD in 2026, but you have to take two RMDs the following year, and you have to take 2026 out by December 31st. So just be mindful of that as you hit that age, what you want to do there. And with RMDs, if you are 70 and a half and you are charitable, you should definitely be doing a qualified charitable distribution. That is where you take money directly out of your IRA and you give it to your church, you give it to the American Heart Association, whatever charity you feel is doing the work you want to see done in the community. By giving it through your IRA as a qualified charitable distribution, it not only reduces your RMD taxable amount, it also allows you to keep the higher standard deduction, the higher senior deduction there. So definitely one way, if you're someone that's older and the donor advised fund doesn't make sense for you because your income isn't high enough to generate doing a lump sum contribution, If you're 70 and a half, you should be giving all your giving through your IRA, through your RMD requirement. And you can start those QCDs at 70 and a half the year you turn 70 and a half. So it actually starts 2.5 years before you hit RMD age. So again, another way you can be charitable today and reduce that RMD burden later in life before they start calculating that for you.
Yeah, Kage, our clients and our people that are on our webinars are probably sick of hearing this, but just to reiterate, and we're telling some clients when they hit 70 and a half, they should never give cash again to their charity, because it should either be coming out of that appreciated stock that we talked about, or here, your traditional IRA when you're 70 and a half. This is an amazing mechanism. And why 70 and a half? Well, the RMD age, required minimum distribution age, used to be 70 and a half not that long ago. That RMD age got bounced up, but the QCD, qualified charitable distribution age, remains at 70 and a half. So please, 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 if you're giving at all to a charity, 501c3, do that through a qualified charitable deduction directly out of your IRA to the charity, henceforth and forevermore.
Perfect. And we kind of walk through an example here of just how they can help you save tax dollars. Is if you are someone that has a $20,000 required minimum distribution once you turn 73, by doing it through your IRA, you're able, if you had 100,000 of taxable income, by going and doing your QCD through there, you can actually get your taxable income down. And we include in that $100,000 taxable income, that 20,000 of that is your RMD requirement. So your base income is 80 plus an RMD of 20. So if you're someone that does the QCD for 20,000 to your church, because that's what you were giving already through your normal cash between Social Security, what you're drawing out of your IRA and other sources, by doing that through your IRA, because of the new senior deduction and the additional deduction for just being above 65, they're kind of confusing, but you get both. You can have your taxable income be $32,500. Whereas opposed, if you're someone that doesn't have that, the issue is that now you're paying taxes on that RMD, and if you're just giving it out of pocket, the charity's getting that after you've paid taxes on it. So less is going to the charities overall on that. And this is an interesting topic because this is something that we've seen become more relevant. I feel like I've seen it become more relevant this year in particular. Is just, as you go through life, how you invest in assets is going to change. If you're someone in your 30s, 20s, you're going to be hyper aggressive. You're going to be all stock and all equities because you're going to ride the waves of the stock market for the next 30 to 40 years and see those gains, whether it be in your IRAs, your Roth IRAs, your brokerage accounts. And as you start to shift towards getting closer to retirement age, you're always told now you need to become a little more conservative, a little more conservative, a little more conservative. And then by the time you get to retirement, now it's, okay, how do we save this principal of cash we saved over 30, 40 years, and how do we efficiently spend that in retirement? And what we often see is with clients that are retired is they've retired, but not necessarily, but they're still keeping their investments invested the same way in their accounts. So one interesting topic that you should look at with your financial advisor is how much income are you needing to live on in retirement? Where is that income coming from? And are there more tax efficient ways to generate that income based off your retirement account? And when you think about that, and why is that relevant? Because if you're someone that's wanting to do Roth conversions and you have a taxable brokerage account that's kicking you out a bunch of dividends every year, that gives you less room to do Roth conversions. So what if there's more tax efficient ways to generate tax-free income or tax-deferred income, have your assets still continue to grow, but now how you're having the funds drawn out is in a tax-efficient manner way that you're paying less taxes for the same amount of income that you're already giving. And the best example I can give of this is people think of your Roth IRA as hyper aggressive all the time, which is true in your 20s and 30s because you want that income to grow you want that growth to be tax-free when you take it out in retirement. Well, now that you get to retirement, the biggest benefit of the Roth IRA is that when you take it out, it's tax-free. And if you have a brokerage account that has a bunch of dividends and stuff, now you're going to get taxed on these dividends when it's coming to you in retirement, whether you use them or not. So one recommendation that I've always looked at with telling clients is that when your income producing assets should come out of your IRAs and your growth assets should be more centered in some of your brokerage accounts. We don't want to be hyper aggressive and have you have huge capital gains where we have the issue of not selling. But with interest and dividends being generated in your IRAs, you're not taxed on it, because if it's a Roth IRA, it's tax free. And if it's an IRA, it's tax deferred, meaning you don't have to pay it when it's paid into your IRA. You can dictate when that money is going to come out until you have RMD age. So you can start to pull the levers of where do I get my tax-free income, my large asset purchases, if I need capital gains, do I have the brokerage account that's growing for me and battling inflation and rising costs? But what I'm actually taking out and using, I'm actually using it to a much more tax efficient way. So definitely as you go into 2026, is if you're someone that's starting to shift from, getting ready for retirement to retirement, just looking at your portfolio as a whole and how your income, what you're going to live on is being generated. And John Mark will tell you this, when you look to do Roth conversions, the best part about a Roth conversion is we can use that to generate tax-free income for you to give you more room for Roth conversions the following year. So, the more willing you're able to change that portfolio earlier in retirement, the longer you're able to get that compounding growth on the tax-free income, more room for Roth conversions, less RMD burden. So definitely something, interesting that we've seen become more relevant over the last year. And as you look into 26, 27, 28, that's something you want to be thinking about with your financial advisor as you approach retirement is how and where do I want my income generated when I'm living in retirement so that I'm not paying unnecessary taxes on growth on that. And for some new limits for 2026, the 24,500 is the new 401k limit. The catch-up rules are still the same, other than if you make above 150,000 of AGI, you're required to do your catch-up post-tax as opposed to pre-tax. And then with the Roth IRA, it's still tax-free, and brokerage account has your most flexibility when the funds are needed. So when we talk about reviewing the timing, method, and amount of charitable giving you do, it really comes into, how charitable do you want to be? And you may want to be charitable later, but not today. And not because you don't want to do it today, just because you haven't found that calling, you haven't found that cause, you haven't found that organization that's making the difference that you want to see done in your community. And from a tax perspective, what's really cool is that the donor advised fund allows you to start stockpiling those donations today, get the tax deduction today, and then when you finally decide, you find that charity, you find your church, or you find that calling, you're able to donate to that charity and have the growth in that account tax-free, because you're going to pull it out and give it to the charity whenever it's needed. But you've been getting tax deductions for the charitable giving all these years without giving the funds away yet to the charity because you haven't found it yet. And whether or not you contribute to a donor advised fund kind of depends on what your situation is year to year. You might get a large bonus at work that jumps up your tax bracket, so you want to get that reduction in your taxable income. You might sell a business, or you might receive an inheritance, and now you're worried about a large tax bill. So again, you want to set aside some of that for charity. Or you're just someone that that's doing awesome at work, and you have the success to just paying high tax rates. So you're extremely generous to get the tax deduction. So when we talk about donor advised funds and the timing giving, that's why if you're a high income earner, donor advised funds make more and more sense for you, because with the raising of the state and local tax deduction from 10,000 to 40,000, you have much more room to give to charity and less of a threshold you have to get to be above that standard deduction. So just for example, we're going to walk through this in the presentation, so I'm not going to harp on it, but essentially any dollar in previous years that you had above 10,000 in state and local taxes was capped. You couldn't use it. Well, now you can use those dollars, so it gets you even closer to itemizing, meaning less of a hurdle that you have to get to in order to be to reach the standard deduction through charitable donations. And so around that, we talked about the donor advised funds, and we've kind of harped on it a lot today. So I'm going to skip through this slide to get to the example real quick. Give me 1 second. So what we're going to walk through is a scenario of that our tax planning software uses, where we talk through, what does it look like if we do charitable donations of $20,000, $30,000, $40,000 based off your situation, and how much of a difference does it actually make in your taxes? Because we all want to be charitable, we also like to see the tax deduction a little bit on the back end to make sure that it's working for us. So in this example, we have two couples, or one was before the tax cut for the OBBA and after it. So this one is after the One Big Beautiful Bill. I'm actually going to show you the one before. So this is someone who made $313,000 as a mix between W-2 wages, interest, and dividends, and their deductions are $30,000, which is a combination of their state and local taxes, their charitable donations, and their mortgage interest. So when you look at this, what we ended up doing was saying, under the previous law, we were capped at $10,000. So if you were someone that had, very little mortgage interest because you're close to paying it off, but you had a lot of state and local taxes, there's a much higher threshold that you had to hit in order to itemize your deductions. So what we showed in this example was, if you gave your normal annual giving, your monthly giving to your church, as opposed to doing a donor advised fund, how the One Big Beautiful Bill changed how much you have to give in order to itemize. So in scenario 2, this is the one without this bill being passed. This couple had $18,000 of state and local taxes. Again, they were hard capped at $10,000 because of that law. Their mortgage interest was $6,000, and they gave $13,333 to their charity, which is a good amount to give, and that's awesome. The problem is that they're still below the standard deduction. So from a tax perspective, I'm not going to tell a client to take less than the standard deduction. So it's like, hey, you're doing great, but we can't take advantage of this charitable giving. Now, with the passage of the One Big Beautiful Bill, we have the same scenario as far as state and local taxes and mortgage interest go. Now, because they make less than $500,000 and they're not capped, they get an additional $8,000 towards itemizing their deductions that wasn't there previously. So with their mortgage interest, they're looking at itemized deduction before charitable giving of $24,000. So if they were to give their standard charitable giving, they would be at $37,000, and they would be able to itemize. While in our case, we would say, well, why don't we lump sum a couple years of givings to your church in 1 year, so we can really take a huge lump out of your tax bill this year before the brackets get higher and everything gets higher for you. So in this scenario, we said, let's donate $40,000 to a donor advised fund because you're already going to be itemizing with those other items. So as you can see here, their itemized deductions are now $64,000 as opposed to $30,000. So when you come down to the taxable income, that makes obviously a $34,000 difference in income, but their taxes saved are almost $8,000 in taxes saved. So now they're able to take advantage, of that charitable giving. So that charitable donation saved them roughly $8,000 in taxes by lumping all their giving they were going to do for the next 3 years into 1 year for tax purposes. But from the church's perspective, they're still going to get the same monthly cash flow every month out of that donor advised fund. So when you're talking about taxes, majority of tax planning comes around, what am I recognizing when? If I'm selling a business, am I selling it all in 1 year, or am I going to recognize it over 3 years? If I'm going to give to charity, am I going to get the full deduction in 1 year, or am I going to space it out over 3 or 4 years? So that's what the majority of tax planning comes down to, is when you're doing Roth conversion, how much do I do in this year to stay in this bracket? Or when I'm looking to do capital gains, how much can I sell to stay in this bracket? It's all about timing. And that's what the donor advised fund lets you to do. It gives you the ability to dictate when you get the charitable deduction. Whether or not you know the charity you're going to give to does not matter when you set up a donor advised fund. We just need to know that at some point in the future, you want to give this money to a charity. And then once it's in the donor advised fund, we can't take it back out. So that's the important thing to note about a donor advised fund. But again, if you're going to give that money to a church, you're not going to give it to the church and then a week later walk and say, I changed my mind, I need my money back. So just remember, when you set up the donor advised fund and it's funded, you just can't take the money back out. It's got to go to a charity at that point. So tax planning is a lot around timing. So being proactive with your advisor can really help you as far as saving taxes, not only like this year, but especially with Roth conversion, can save you thousands of dollars in the future by being proactive and handling it before you hit RMD age. Because once you hit RMD age, it's much harder to do Roth conversions because your Roth conversion does not satisfy your RMD. So if you were someone that's required to take $20,000 out of an IRA from an RMD, you do a $20,000 Roth conversion, you still got to take out another $20,000 to satisfy your RMD. So that's why it's so crucial if you're looking to do Roth conversions, you need to look between your windows of when you retire and when you hit RMD age as the optimal time to do Roth conversions before you have that RMD requirement. But with that, I don't have anything else. I don't see any other questions in the chat. I will hand it back to Tim, John Mark, if they've got any closing thoughts. And I just am blessed they brought me on for the webinar, and I hope everyone has a wonderful Thanksgiving. And we all hope the Cowboys lose on Thanksgiving. So that's
easy there. Kage, why don't you let folks know? I know we've been sending many of our wealth management clients to you for taxes. Let folks know how to reach out to you, get on your list if they need help with their taxes this coming year, or even if they want some advice before the end of the year. How do we get a hold of you?
Certainly. So you can your financial advisor, usually go through your financial advisor, say, hey, I would like to be added to the tax list, and the advisor will tag us on an email together. And from there, I always like to do an introductory phone call just to get a better understanding of your situation, make sure we're not missing anything for you from a tax perspective. And then once you're on the list, at the end of January, we send out our tax organizers and stuff. But you can either email me at kagerush@whitaker-myers.com, and we'll send that up in the follow-up email if you do want to get registered or not. It's also in the weekly newsletter. There's a link to help if you want to get registered as well. But again, just being proactive to get added to the list, that's the biggest thing that helps us because as we get through tax time, I have less and less time to schedule meetings, unfortunately. So I try to help as much people as we can. So the earlier you're able to get on our list, we can guarantee that it gets done in a time-efficient manner.
Yep, sounds great. And stay up to date with us at whitakerwealth.com. New webinars coming out every month. Keep posted. Subscribe to our YouTube channel. Thank you so much for joining us. Have a very happy Thanksgiving and a great time with your families. God bless.